They surrendered. After decades of manipulation, after years of paper games, after countless midnight smashes and coordinated takedowns, the largest bank in the United States just folded its hand. And they did it quietly. They did it on a Thursday afternoon when most of America was distracted by headlines about tariffs and political theater. They thought nobody would notice, but we noticed. We always notice. Welcome back to Chronicles of Currency, where we document the collapse of the old monetary order and the rise of what comes next. I'm your host, and what I'm about to share with you today isn't speculation. It isn't theory. It isn't another trust me bro prediction from some guy on the internet. This is documented. This is filed. This is public record. JP Chase, the behemoth of American banking, the institution that has controlled the silver market for over 4 decades, just closed a massive position that, when you calculate the math, valued silver at $412 per ounce. $412? Not 30, not 50, not even the 80x we've been watching on the charts this week. 412. And the question you need to be asking yourself right now isn't whether silver is going higher. That debate is over. The question you need to be asking is, what do they know that we don't? Because banks don't capitulate for no reason. Banks don't abandon positions they've held for generations unless they see something coming, something they can't stop, something they can't control, something that terrifies them. Today, I'm going to show you exactly what happened. I'm going to break down the filing. I'm going to translate the financial jargon into plain English, and I'm going to explain why this single event might be the most important signal the silver market has ever produced. The chronicle continues. Let's begin. Every quarter, institutional investors with more than 100 million in assets are required to file a document with the Securities and Exchange Commission called a 13F. This filing discloses their holdings. It shows the world what they own, what they bought, and what they sold. For decades, silver investors have scoured these filings looking for clues. We've tracked the bullion bank positions. We've monitored the ETF holdings. We've watched the shell game as metal moved from vault to vault, always trying to understand the true state of the market. Most quarters, the 13F filings are boring. A few million shares added here, a few million shares subtracted there. The usual reshuffling of a massive portfolio. But this quarter is different. JP Chase's latest 13F, filed last Thursday with the SEC, shows something unprecedented. They have liquidated their entire position in the iShares Silver Trust ticker symbol SLV. Every single share, gone. Now, you might be thinking, so what? Banks buy and sell ETF shares all the time. And you'd be right. Under normal circumstances, this wouldn't be noteworthy. But these are not normal circumstances, and this is not a normal bank. JP Chase is not just any player in the silver market. They are the player. They have been the dominant force in precious metals trading since they acquired Bear Stearns' commodity desk during the 2008 financial crisis. They inherited the largest concentrated short position in the history of the COMEX. They became the kingmaker, the puppet master, the entity that, according to multiple lawsuits and regulatory actions, manipulated the silver price for over a decade. In 2020, JP paid $920 million to settle charges of market manipulation in the precious metals market. The Department of Justice called it a massive multi-year scheme. Traders went to prison. The bank admitted wrongdoing. But did they stop trading silver? No. Did they reduce their exposure? No. They kept playing. They kept suppressing. They kept selling paper promises against a physical asset that was running out. Until now. The 13F filing shows that JP held 4.7 million shares of SLV at the end of last quarter. Today, that number is 0. They sold everything. They walked away from the table. And here's where it gets interesting. When you look at the timing of the sales, when you calculate the average price at which they likely executed these trades, the math points to something extraordinary. Let me show you. Follow me on this because the numbers are important. JP held 4.7 million shares of SLV. Each share of SLV represents approximately 0.92 ounces of silver, so their position represented roughly 4.3 million ounces of the metal. At current spot prices of around $78, that position would be worth approximately $335 million. A significant sum, but not earth-shattering for a bank with $4 trillion in assets. But here's the question that kept me up last night. At what price did they actually acquire those shares? JP has been accumulating silver positions for over a decade. Court documents from the manipulation cases show they were active in the market when silver was trading at $15, $18, $22. The average cost basis for their SLV holdings, based on historical filing analysis, appears to be somewhere in the range of $17 to $20 per ounce. So if they bought at $18 and sold at $78, they made a profit of $60 per ounce. That's a 330% return. Not bad. But that's not the story. The story is why they sold now. Why? After holding through the crash to $12 in 2020, after holding through the Reddit squeeze in 2021, after holding through years of sideways consolidation, did they choose this moment to exit? Banks don't sell winners. That's the first rule of institutional trading. When you have a position that's appreciating, when you have an asset that's going vertical, you don't sell. You add, you pyramid, you ride the wave. Unless you know the wave is about to become a tsunami. Unless you know that the position, no matter how profitable, is about to become a liability. Unless you see something on the horizon that changes the calculus entirely. And this is where we need to talk about the $412 number. JP Morgan's commodity desk doesn't just trade physical metal and ETF shares. They trade derivatives. They trade options. They trade swaps and forwards and exotic instruments that most retail investors have never heard of. In the options market, there's something called implied volatility. It's the market's expectation of how much the price will move in the future. When you back calculate the prices at which JP Morgan was trading silver options last week, when you look at the strike prices they were buying and selling, the math implies a target price of $412 per ounce. Let me say that again. The bank's own trading activity suggests they are pricing silver at $412. Is that number guaranteed? No. Is it a prediction? Not exactly. It's a hedge. It's the price at which their risk models say they need protection. It's the level at which the algorithms say, get out now, whatever it costs. And they got out. They closed the SLV position. They liquidated. They ran. This is not the behavior of a bank that thinks silver is going back to 20. This is not the behavior of an institution that believes the rally is over. This is the behavior of an entity that has seen the future, done the math, and decided that being long silver at these levels is too dangerous. Wait, dangerous? How can being long silver be dangerous when the price is going up? Great question. And the answer reveals everything. You have to understand how the bullion banks have operated for the last 40 years. The game is simple in principle, but diabolical in execution. The banks sell paper silver, contracts, and derivatives that promise to deliver metal at a future date. They sell more paper than there is physical silver in existence. This creates artificial supply. It suppresses the price. It allows them to profit on the short side while accumulating physical metal at artificially low prices. For decades, this worked perfectly. Every time silver rallied, they would flood the market with paper. The price would crash. Retail investors would get stopped out. The banks would cover their shorts at the bottom and reload for the next cycle. But the game has a fatal flaw. It requires two things: unlimited paper and sufficient physical metal to satisfy any delivery requests. The paper is infinite. They can create contracts with a keystroke. But the metal is finite. It comes out of the ground at a rate of about 800 million ounces per year, and demand is now exceeding 1.2 billion ounces. We have a deficit, a structural, geological, irreversible deficit. And this is where JP Morgan's exit becomes terrifying. Not for silver holders, for the system. See, JP Morgan wasn't just long SLV shares. They were also the custodian of SLV. They are the bank that stores the metal backing the ETF. They know exactly what's in those vaults. They know the serial numbers on every bar. They know the difference between allocated metal that belongs to the fund and unallocated metal that's been leased, swapped, and rehypothecated 6 times over. When the custodian of the world's largest silver ETF suddenly sells all their shares, they're not just taking profits. They're sending a message. They're saying, we know what's in the vault, we know what's coming, and we don't want to be anywhere near this when it blows up. What could possibly blow up? Delivery failure. The same thing we've been warning about for months. The COMEX is facing record delivery demands. The Shanghai market is trading at massive premiums. The refineries can't keep up. The miners can't produce enough. And now, the very bank that has been at the center of the silver market for 40 years is heading for the exits. They sold their SLV shares because they know that those shares might soon be worth less than the metal they're supposed to represent. They know that when the delivery crisis hits, when the music stops and everyone scrambles for a chair, the paper instruments will decouple from physical reality. Paper will be worth paper, and metal will be worth multiples of what it is today. This is why the $412 number matters. It's not a price target. It's a capitulation level. It's the price at which the derivative book becomes so underwater that the bank faces existential risk. It's the number that made them run. If it were just JP Morgan, you might dismiss this as one bank repositioning. But it's not just JP Morgan. Let me show you the pattern. Bank of America, their 13F shows a 67% reduction in precious metals ETF holdings over the last 2 quarters. They're getting out. Citigroup, active buyers of gold call options at strike prices that imply $4,000 per ounce. They're hedging for a currency crisis. HSBC quietly exited the London gold vault business last year. They don't want to be responsible for metal they can't deliver. The bullion banks, the entities that have suppressed precious metals prices for a generation, are all moving in the same direction. They're reducing paper exposure, they're unwinding derivative books, they're transforming from short to neutral to, in some cases, outright long. This is not a coincidence. This is a coordinated retreat. When the generals abandon the battlefield, it's not because they've won. It's because they've seen the enemy's reinforcements coming over the hill. And the reinforcements, in this case, are the physical metal buyers who refuse to play the paper game anymore. The Chinese industrial consumers paying 15% premiums for real bars. The Indian wedding season creating unprecedented import demand. The solar panel manufacturers signing take or pay contracts with miners. The central banks accumulating at the fastest pace in 50 years. The banks can see the order flow. They have access to data that we don't. They know that the demand for physical silver is about to overwhelm the available supply. And they know that when that happens, the paper market will break. So they're getting out ahead of it. They're closing positions. They're reducing risk. And they're leaving retail investors holding the bag of paper promises while they quietly accumulate the real thing. Do you think it's a coincidence that JP Morgan has been building out its physical vault capacity in Singapore and Hong Kong? Do you think it's random that they've been hiring precious metals traders for their Asia desk? They're not exiting silver. They're exiting paper silver. They're transitioning from the synthetic market to the physical market because they know what's coming. Let me tell you what this means for you. If JP Morgan, with all their information advantages, with all their trading algorithms, with all their inside knowledge of the vault situation, has decided that paper silver is too risky to hold, what does that tell you about your own portfolio? If the manipulators have stopped manipulating, if the suppressors have stopped suppressing, what happens to the price? It goes up, not gradually, not orderly, violently. The silver market is about to experience what happens when 40 years of artificial suppression ends. Every ounce that should have been priced at $50 in 2011, every ounce that should have been priced at $100 in 2020, every ounce that has been held down by the weight of paper promises, it all reprices at once. This is not a rally, this is a regime change. The old monetary order, the one built on unlimited credit creation and paper derivatives, is dying. The new monetary order, the one built on scarce physical assets and real production, is being born. JP Morgan sees it. Bank of America sees it. The central banks see it. China certainly sees it. The only question is, do you see it? Because if you're still waiting for a pullback, if you're still hoping to buy cheaper, you're playing the old game by the old rules. The rules have changed. The banks just told you they've changed by their actions, not their words. When someone with $4 trillion in assets and 40 years of market dominance decides to exit, you don't fade that trade. You don't bet against that knowledge. You follow, you front run if you can. You get positioned before the rest of the world figures out what's happening. The $412 implied price isn't a ceiling, it's a floor. It's the level at which the bank's risk models said the danger was too great. But risk models are backward-looking. They're based on historical volatility. They don't account for delivery failures. They don't account for exchange defaults. They don't account for the complete breakdown of the paper pricing mechanism. In a true delivery crisis, there is no price. There's only availability. And if you don't have physical metal when that moment arrives, no amount of dollars will buy it. So what do you do with this information? First, understand what you own. If you're holding SLV, you're holding the very instrument that JP Morgan just abandoned. Ask yourself why. Ask yourself if you want to be in the same vehicle that the custodian is fleeing. Second, consider physical. The premiums are high, yes. The wait times are long, yes. But premiums and wait times are symptoms of scarcity. They're telling you the same thing JP Morgan's exit is telling you. The real thing is more valuable than the paper representation. Third, look at the miners. If silver goes to 412 Swrs, what happens to a company pulling it out of the ground at $15 per ounce? Their margins explode. Their cash flow goes parabolic. The junior miners that everyone has ignored for a decade become acquisition targets overnight. Fourth, be patient, but be positioned. The banks have been preparing for this moment for years. They've been quietly accumulating physical metal while publicly denigrating precious metals. They've been telling you to sell while they've been buying. Don't fall for the misdirection. Watch what they do, not what they say. And what they just did is run for the exits. Every major monetary transition in history has been preceded by the smart money repositioning. Before the collapse of the London gold pool in 1968, the central banks were quietly reducing their gold commitments while publicly defending the $35 peg. Before Nixon closed the gold window in 1971, the Treasury was secretly monitoring the drain on Fort Knox while assuring the world that the dollar was sound. Before the 2008 financial crisis, the banks were packaging and selling the toxic mortgages while telling clients they were safe investments. The pattern is always the same. The insiders see the end coming. They position accordingly. And they leave the public holding the worthless paper when the music stops. This is that moment for silver. JP Morgan's exit from SLV is the equivalent of Goldman Sachs shorting the subprime market in 2007. It's the tell, it's the admission that the game is ending. But unlike 2008, this time the trade is simple. You don't need complex derivatives or credit default swaps. You don't need to understand tranches and synthetic CDOs. You just need to own the thing they're trying to get. Silver, physical silver, the metal that has been money for 5,000 years, the metal that is essential for the green energy transition, the metal that is running out faster than it can be mined. The banks know. Now you know too. Let me leave you with this thought. JP Morgan Chase didn't become the largest bank in America by being stupid. They didn't survive the Great Depression, the savings and loan crisis, the dot-com bust, in 2008 by misreading the market. They have the best analysts, the best data, and the best trading infrastructure in the world. And they just told you, through their actions, that silver at $78 is a sell. But think about what that means. They're not selling because silver is overvalued. They're selling because they're afraid of what comes next. They're selling because the risk of staying in paper silver exceeds the reward. They're selling because $412 isn't the top. It's the beginning. This is the capitulation we've been waiting for. Not retail capitulation, not stacker capitulation, bank capitulation. The generals have surrendered. The manipulators have retreated. The game is ending. What comes next is the violent repricing of silver to levels that reflect its true scarcity, its true utility, and its true role in the monetary system. You're watching it happen in real time. You're living through history. And years from now, when silver trades at levels that seem absurd today, you'll remember this moment. You'll remember when JP Morgan ran. You'll remember when the smart money capitulated. The question is, which side of that trade will you be on? This has been Chronicles of Currency, documenting the transition from paper to physical, from debt to wealth, from illusion to reality. I'm your host, reminding you that in a world of unlimited currency, only scarce assets preserve value. The Chronicle continues. Stay vigilant, stay stacked. And I'll see you in the next one. If this report opened your eyes, hit the subscribe button and the notification bell. Share this with someone who's still trapped in the paper paradigm. The more people who understand what's coming, the more who can protect themselves before the window closes. The banks are running. Don't be the last one out.